All right, let's dive right into this explainer and unpack the actual reality of Social Security. We hear headlines all the time, right? Some are totally panic-inducing, others just brush it off. But today, we're looking strictly at the mechanics and the hard data. Whether you're cashing those checks right now or you're just starting out in your career, let's figure out what this really means for your financial future.
2033. Now, I know it sounds kind of like a date from some sci-fi movie, but guys, it is literally just around the corner. We are counting down to this exact year because the program's very own trustees project that the combined trust funds won't be able to pay out full scheduled benefits anymore. And this isn't just some wild guess. It's a mathematical projection based on current laws and the reality of our demographics. The clock is definitely ticking.
So here is the immediate problem staring us right in the face. After that 2033 deadline hits, the tax is still rolling in from active workers. Well, they're only going to cover about 77% of scheduled benefits. If Congress doesn't step in and do something, we're looking at a stark 23% cut. That's nearly a one-quarter reduction in expected income for folks.
And to really wrap our heads around why a 23% cut is just monumental, we have to grasp the sheer scale of this program. As of September 2025, we've got 68 million people relying on these monthly benefits. The program is set to pay out roughly $1.6 trillion in 2025 alone. That's massive. This isn't some minor administrative hiccup or a tiny niche government program. It is one of the absolute largest cash flow systems operating in the entire U.S. economy. When a machine this big faces a 23% shortfall, the economic ripples are going to be huge.
Okay, moving on to unmasking the mechanics, how Social Security actually works. To really understand why the shortfall even exists in the first place, we've got to look under the hood.
First things first, we need to completely shatter a super common illusion. The popular myth is that Social Security is this giant, personalized vault where the government just locks away your specific tax dollars. Maybe with your name etched on a little gold plaque on the door. But the actual reality? It is a pay-as-you-go system. The dollars coming out of your paycheck today are not being saved for you. They are literally going right out the door to finance today's retirees.
Which brings us to a phrase you probably hear all the time, the trust fund. See, when payroll taxes exceed payouts, which, by the way, did happen for many years, the surplus is invested in special treasury securities. So ultimately, the trust fund is essentially just a claim on future federal cash flow. It's basically a government IOU to itself, paid out of general funds. It is not a pile of diversified market assets like you'd have in a private 401k.
Once you understand that pay-as-you-go structure, the root of the trouble becomes pretty obvious. It's a widening mismatch between incoming taxes and outgoing benefits. We've got this massive wave of baby boomers retiring, which means a lot more money is going out. Meanwhile, the taxable wage cap kind of constrains the money coming in. It's simple math, really. More money going out, constrained money coming in.
So this means we really have to view Social Security through the correct lens. It isn't a business generating private equity profit. It is a federal transfer system. And because it relies on Treasury obligations to cover shortfalls, it's directly tethered to things like demographics, fiscal politics, and frankly, the bond market's confidence in U.S. public finance. It's a living, breathing political mechanism, not some static lockbox.
All right, up next, the real-world impact, breaking down the math. Let's see what actually happens to the dollars and cents if that trust fund shortfall triggers those automatic reductions.
Because we're not just talking about abstract percentages anymore. A 23% cut means pulling roughly $455 a month straight out of the average $1,975 check. For a typical retired couple, that translates to an $18,400 loss per year.
Just imagine waking up in 2033 to a near $20,000 hole in your annual budget. I mean, for a household on a fixed income, that's an absolute earthquake.
And the downstream effect of this is honestly staggering. Losing that income is a massive shock for seniors who rely on it as their main safety net. We're talking about a direct hit to basic household consumption. It forces really tough choices on things like healthcare and can completely destabilize housing. When 68 million people suddenly have way less spending power, you better believe it impacts local economies, retail, and healthcare systems across the entire country.
Let's pivot a bit to the generational dilemma. Who is most vulnerable? Because if you're sitting there thinking this impact is restricted only to current retirees, we need to completely shift our focus right now.
This number right here, this is a major wake-up call. 20%. According to a super comprehensive 2024 TIAA study, an alarmingly low 20% of Gen Z workers are currently saving for retirement. Let that sink in. That means 80% of our youngest workforce is entering the economy with zero personal safety net being built.
And it gets even more concerning when we dig into the why. 35% of Gen Z respondents explicitly admitted they don't even know where to begin saving. It's not necessarily a lack of desire, right? It's a profound lack of financial direction and literacy when it comes to private market investments.
So when you put all these pieces together, it creates a really dangerous paradox. The generation most likely to depend on this strained pay-as-you-go system decades from now is currently the least prepared to replace that income privately. If Social Security faces this severe compression, the people who are going to be hit the absolute hardest in the long run are the younger workers who just aren't building their own independent wealth today. Which brings us to redefining Social Security, a new mental model. How do we actually fix this and empower your financial future without getting all caught up in the political panic?
Well, first, we have to identify the actual threat. The real risk isn't some clean collapse. Social Security isn't just going to vanish into thin air tomorrow. The real risks are benefit compression, delayed reform that causes sudden shocks, and stealth redistribution. What does that mean? It means lawmakers fixing the math through higher taxes, pushing back eligibility ages, or tweaking those delayed claiming incentives, all of which quietly erodes the overall return on the taxes you've already paid into the system.
Therefore, we have to completely reframe our understanding. Look at it this way. Social Security is a political cash flow contract between generations. It is not a guaranteed retirement asset sitting in a vault with your name on it. It's entirely dependent on the political and demographic realities of the generation coming up right behind you.
And this leads to the ultimate mental shift for Gen Z, Millennials, and really anyone with years left in the workforce. You need to model the system's future like a lower confidence annuity with policy risk rather than a guaranteed pension. You should expect partial protection. Yes, some money will absolutely be there, but you've got to model for lower real replacement rates. You pretty much have to assume it's going to cover less of your life than it did for your grandparents.
So, knowing the true mechanics, understanding that demographic mismatch, and hearing that ticking clock counting down to 2033, I want to leave you with this to ponder. How does viewing Social Security as a lower confidence annuity change your retirement roadmap today? If that check is going to be 23% lighter, what actions are you taking right now with your own savings, your investments, and your career to bridge that gap? Let that question drive your financial decisions this week. Thanks so much for joining me on this explainer, and hey, start mapping out your independent financial future today.